Now let's pull the lens out a little bit from here. One of my regulars, there's always lots of fun, is Grant Patterson from Providence Wealth. Well, Grant, we were suggesting when we were coming onto the program that we were in for some bumpy times. Did you expect overnight to be quite so bumpy?
Well, over 40 years in markets, I don't ever try and predict what happens overnight. So it was quite a big reversal. I think, you know, one of the interesting things is the volatility that's now starting to come into markets, which is normally the sign of an ongoing correction. When the volatility gets so high, people start to lose a bit of confidence, and you know the reversal was quite stunning, from the night before. So quite a big move.
All right, so we have bumpy moves like that, but the big picture, which is what we're called, the big picture is inflation and rising interest rates. So bumps notwithstanding, that's still how you position your portfolios. Where is your money sitting, Grant?
Well, our money has been, as we've been mentioned here on the program before, we've been very, very diversified and making sure that we've got some non-correlated assets in the portfolio just to protect us at this late stage of the cycle. I mean, we were talking before about the tide turning. I mean, the tide is now starting to go out, and really there's a macro regime change. We've had, for the last decade or so, a regime whereby global growth's been above trend, inflation has been benign, interest rates have been declining, and so really it didn't matter what asset class you own.
Everything rallied?
Bonds, equities, property, the lot, and so that was a tremendous asset inflation period of time. I think now that Goldilocks environment has changed. We're starting to see, obviously, Fed increasing interest rates, so we're not going to see the decline at this stage. Growth is challenged, we believe, a couple of years down the track, and therefore, for investors, I think it's going to be quite a challenging few years ahead.
So can I ask a question on that actually, because it's sort of one of investment principles in this environment, and everyone was speaking about for the last 6 months, the death of the risk parity trade or whatever it happens to be. In this environment where we are seeing stocks and bonds sell off together, how do you diversify your portfolio to protect capital, if nothing else, or where do you allocate yourself in this sort of environment?
Yeah, it's a very good point, because as you mentioned, the bonds have sold off roughly about 9% since the beginning of the year, and that's supposed to be your defensive part of the portfolio. And as it turns out, we are actually investing in Australian government bonds today.
Right.
We believe above 3%. A lot of the news about inflation and a more aggressive Fed is now built in, we think, to Australian bonds.
Yeah.
So above 3%, we think it's a good place to hide, if you like, for that defensive character. But also some of the alternative asset classes is where you can get some defensive, non-correlated protection for your portfolios. We've had gold in the portfolio for some time. That serves its purpose in these sort of times. And in regards to our international equities, we have them hedged back into the Australian dollar, as we saw last night. When risk is off, the Australian dollar tends to fall, and that protects the international portfolio somewhat.
Right.
It sure does. Now, as we know, everyone is lifting their cash rates to various degrees, and the Bank of England overnight, with its 25 bips, basically said we're hiking because we're worried about inflation, but gee, there's a slowdown coming. Now, we had a very brief inverted yield curve. Everyone was talking recession. We're off that subject. What's your view on the recession, and how do you invest for that?
I think the probability of a substantial slowdown, a year and a half, 2 years, is increasing. I mean, as the interest rates are moving up, we've got elevated input prices and cost of living pressures that's not going away, with fuel prices and food prices, and with the increase in interest rates and the extra mortgage costs. I mean, it's not hard to see how the consumer starts to slow and be under some stress. So I think that the biggest miss that the Fed's ever done in regards to inflation forecasts about transitory, I think we're now probably at a bit of a short-term peak in the rate of change of inflation, but input prices are going to remain high. Therefore, I think global growth will be challenged. And how do you invest for that? You ensure that you've got assets that can ride through the cycle. You try and have a look at assets that aren't correlated to the day-to-day GDP growth, and that could be regional hospitality we've spoken about before, specialist disability housing, retail shopping in regards to non-discretionary suburban centres. So, you know, you try and look through that period of time.
So with that as well, because there sort of seems to be the implication there that maybe the rates markets have overcooked expectations with central bank policy, that I think the phrase being used a lot is something breaks along the way. You know, in terms of the way investors are positioning for this, and almost from a psychology point of view, there's a lot of panic in the market at the moment. How, if you were to, you know, speaking, you know, hypothetically to your mum and dad at home, obviously in a very general nature, you know, how do they weather this storm, and how do they sort of traverse this environment where there is that sort of major risk that, you know, policy is over tightened and your investments are really potentially hit in this?
Well, it depends on whether they're investors or traders. I mean, in the last decade or the last few years with the Robin Hood phenomenon, we've seen people trade and pump the market and buy the dips, which has been great while interest rates continue to decline. Well, now the hard work gets done. I mean, we've had these huge inflows into passive ETFs, which have bought the index, which meant that the index keeps going up, which means the bigger stocks keep getting bigger and bigger and bigger, and it's self-fulfilling. When that turns and the outflows come from the ETFs, then the same thing applies on the reverse. The same stocks keep getting sold, and we've seen enormous carnage in some of the tech names. You know, a Spotify and Netflix down 60%, ARK Investments down 70-odd%, Robin Hood down 85%. There's stunning numbers. I mean, they're not dissimilar to what I remember seeing pre-1987, pre-October 2000. Now, I'm not, you know, not forecasting that, but I think we are seeing the signs of a correction to continue to roll on in these markets, and it's going to be volatile. So my advice would be stick with value, fundamentals, ride through the cycle, and try and avoid the short-term noise, because there's going to be some great opportunities, and they may be already there in some of the smaller tech names. So, you know, we've just got to keep a level head during this period of time. Active management will make a huge difference during this period of time. The dispersion of returns will be enormous, and active managers will certainly be earning their stripes.